As we head into the tail end of the year, both buyers and sellers have continued to pull back in the market. We've seen sales declines of over 50% relative to last year. So are we finally seeing the big pricing declines that many people have been speculating about? I'm Adina Dragosanu, Oakland Realty, here with your December 2022 market update. Let's start off looking at sales. In the month of November, we had just over 1,600 sales here in Metro Vancouver. This is a decline of about 15% relative to October, and it was down about 53% relative to November last year. If we look at it compared to the 10-year sales average, we see that it was down 37% below the sales average. With sales down 53% relative to last year, many buyers have been anticipating, or rather hopefully anticipating, significant price declines. Yet when we look at the HPI Benchmark price, we see that prices are only down about 0.6% relative to last year, and they're only down about 10% from their peak. So why is this? To understand why this is happening, we need to look at the supply side, so inventory levels. If we look at the total number of homes that became newly listed for sale in the month of November, we see that this number was down 24% relative to October and down 23% relative to this time last year. So it's not just buyers pulling back. We're seeing that sellers are also reluctant to list their homes for sale right now. And with this, we've seen that the total of inventory of homes available for sale has declined about 7% relative to October, and it's up about 28% relative to last year. But we have to remember that last year were some of the lowest inventory we'd seen in the month of November. So if we look at this interplay between sales activity and inventory, we see that our sales to active listings ratio for the month of November was 17.6%. So we're still well into balanced market territory. If you recall, analysts say that we're in buyer's market territory when this ratio is below 12%. That's when we see downward pressure on prices. And when this ratio is over 20%, we're in seller's market territory and we typically see upward pressure on prices. Looking at this by property type, we see that the ratio is currently at 13% for detached homes, 20% for townhomes, and 21% for condo apartments. Circling back to how this is affecting prices, we see that the HPI benchmark price for detached homes declined about 2% relative to October, and it's down about 1.7% relative to November last year. For townhomes, the HPI benchmark price has declined about 1.5% relative to October, but it's actually up still about 2.7% relative to November of last year. And when we look at condo apartments, the HPI benchmark price has declined about 1% relative to October, and it's up 3.5% relative to November of last year. So what does this mean for you? Well, right now what we're seeing is that a lot of buyers and sellers are sitting on the sidelines speculating about what's going to happen in the market in the spring. And the truth is that there are a lot of factors at play, and it's not really clear exactly what will happen in the next 6 months. There's a lot of reason to believe that prices may come down and we get more inventory on the market. On the second hand, if inventory continues to decline like we've been seeing the last few months, we might not see prices come down. And what it seems that we've lost sight of is that real estate is a long-term game. You really should be looking at this as a 5 to 10 year strategy, not as a 3 to 6 month strategy. Trying to time the bottom of the market or maybe time when the market's going to come back up is a very risky strategy, especially if you're talking about your primary residence. While it's always hard to predict what's happening in the short term, we can look at the long-term indicators to see where prices might head in the next few years. One of the most significant factors I think will drive our market in the next 2 to 3 years is the increased immigration targets by the Government of Canada. If you recall in the last video, the Government of Canada has announced that it's increasing our immigration targets from about 200,000 to 300,000 people a year up to 400,000 to 500,000 people a year, escalating starting last year until 2025. So we have projected 2 million new immigrants coming to our country in the next 3 to 4 years. I think this is going to have a big impact on our market. So if you really are trying to be strategic, I think you need to look at the long-term indicators. And the big things that drive housing is population growth and housing supply. And if we look at price gains in our region over the last decade and more, we see that the people who have made the most money are the ones who got in early and held onto it for the longest. Looking at the stats, we see that in the Lower Mainland, our prices have increased about 30% in the last 3 years and over 86% in the last 10 years. So I really think you need to be focused on the future and looking at a longer trajectory than the next 3 to 6 months. So if you are thinking about making a move or exploring your options for 2023, get in touch and let's help you get ahead of the market. In the meantime, be sure to stay connected. You can follow me on Instagram at adina.yvr and hit subscribe here on YouTube. Wishing you a very happy holidays, and I can't wait to see you in the new year.